Cement Earnings Conference Call for the quarter and year ended 31st March 2026, hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will remain in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal the operator by pressing star, then zero on your touchtone phone. Please note that this conference is being recorded. I will now hand the conference over to Mr. Vaibhav Agarwal from PhillipCapital India Private Limited for opening remarks. Thank you, and over to you.
Thank you, Ryan, and good evening, everyone. On behalf of PhillipCapital India Private Limited, we welcome you to the Q4 and FY26 call of JK Lakshmi Cement Limited. On the call from JK Lakshmi Cement, we have with us Mr. Arun Shukla, President and Director, and Mr. Sudhir Bidkar, Executive Director, Corporate Affairs and CFO of the company. I would like to mention on behalf of JK Lakshmi Cement Limited and its management that certain statements that may be made or discussed on this conference call may be forward-looking statements based on current management expectations and also something that relates to future expected business developments by JK Lakshmi Cement's management. Such statements are subject to a number of risks, uncertainties, and other important factors which may cause the actual developments and results to differ materially from any management projections made on this call. JK Lakshmi Cement Limited and the management of the company assumes no obligation to publicly update or alter these forward-looking statements, whether as a result of any new business development, information, or future event or otherwise. Also, participants can download a copy of JK Lakshmi's Q4 and FY26 results presentation from the company website or stock exchange websites. I will now hand over the floor to management of JK Lakshmi Cement for their opening remarks, which will be thereafter followed by an interactive Q&A. Thank you, and over to you, sir.
Yeah, thanks, Raghav. Good afternoon to everyone. And I have some, little sore throat, so forgive me for some, disturbance in my voice today. But anyway, I'll just start. I'll give you a brief update for the quarter and the whole year, how it looks for us and for industry. And since we have already uploaded this quarter 4 performance, we'll have question answers thereafter that. So during the financial year 2025-26, pan-India cement demand grew by about 7%. To reach to about 480 million ton, estimated 480 million ton. This is an improvement over 5% YOY demand growth recorded in 2024-25. Overall, quarter 4 FY26 demand growth is estimated at about 6 to 6.5%. Volume about 17% quarter over quarter, driven by broad-based action. Cement demand remained strong during December 25 till about February 2026, so 8 to 10% growth, but moderated during March, which is estimated at around 5% due to weak sentiment amid Middle East conflict. Supply side witnessed highest ever annual capacity addition of 64 million ton. The national effective installed capacity reaching now to 712 million ton in March 2000 at the end of March 2026. The highest capacity was added in the east, followed by north, south, and central India. West added the lowest capacity during the financial year. This led to an adverse impact on the overall demand-supply equation, with pan-India capacity utilization estimated to be at around 69% and marginally lower than previous year. On pricing side, cement prices witnessed partial recovery, particularly in non-trade segment during quarter 4 FY25-26. On a quarter-over-quarter basis, after slipping beyond GST pass-through level in the preceding quarter, which is around 22nd September 2025. Substantial capacity addition during the financial year 25-26 and intense competition restricted meaningful price hikes. Fuel costs surged sharply because of this geopolitical situation. Petcoke prices up by about 40% quarter over quarter to about $160 per ton level, and that is again quite fluctuating. Coal prices also went up by about 30% quarter over quarter. Operating costs likely to decline in the last quarter for the entire industry due to operating leverage and stable freight and input cost. Limited price hike constrained marginal expansion despite cost efficiencies. Now on outlook part of it, what we see, volume growth during FY25-26 was driven by, of course, housing demand, infrastructure, and is likely to remain in the range of about 5.5 to 6% or 6.5%. This is what our estimation is. Cement demand outlook suggests slowdown with pricing power staying weak despite sector consolidation. Energy costs are expected to rise by about at least 300 rupees, and packaging costs about 80 to 100 rupees per ton, and that is going to impact maybe in coming quarters because of this geopolitical situation. If the Middle East conflict is sustained for a longer period of time, then operational expenditure may go up even more than that. Capacity addition may slow down. This is what we see in the backdrop of West Asia crisis. Industry to continue on efficiency improvement trajectory coupled with Go Green focus. Sustainability agenda in focus with key initiatives spanning renewable energy, scale up, thermal substitution, emission reduction, and EV deployment is the talk of the day. AI and digital deployment is also emerging as a key lever of productivity and efficiency improvement. Overall, we see that FY26-27 cement demand is likely to grow at about 6% or so. So this is what just a brief top line of the industry for the whole year and quarter, and this is what we think as of today. Now, since we have already uploaded our result, that is there with you. Now we can have questions and answers over that. Thank you so much.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use their handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We take the first question from the line of Sanjeev Kumar Singh from Motilal Oswal Financial Services Limited. Please go ahead.
Thank you for the opportunity, sir. 2 questions. You spoke about grinding capacity addition in FY26. So what is the clinker capacity addition in your view? And going forward in FY27-28, what sort of capacity addition are we foreseeing?
So 26-27 estimated to be about, again, estimation. Our estimation is about around 45 to 50 million ton. Right? Last year it was about 64 million ton. And this is the cement capacity. Now you have to apply that, clinker factor, whatever, clinker factor is there on an all India basis, which is about maybe about 1.6 or so.
Okay. So, grinding capacity addition. When about 300 rupees kind of a cost increase, so my view is that generally we will see 150, 160 rupees in 1Q, and then rest will be in 2Q. So what sort of price increases have been taken, has the industry taken so far? And also, is there any pressure on demand which has been seen in the months of April and May?
So April demand was better. May, when we started, there was sluggishness, and because of the reason, because typically wherever we operate, I think laborers had gone to their respective places for election. Now there was some delay on account of they are coming back, so that impacted demand to an extent initially. But I see little better demand 15th May onward. So April was better. May initially it was sluggish because of combination of reasons, and of course I think there was a big uncertainty around this geopolitical conflict also, and that has got rub-off effect on the cement industry as well. But May 15th onward, I see a little bit green shoot in demand in the month of May.
And anything on price increases, sir?
So price increase, as I mentioned initially, that there was some price increase in non-trade segment in various areas. There is some trade price increase also, but as I said that those price increases are not at all kind of commensurating with the cost increase which we are foreseeing.
Okay, sir. Thank you.
Thank you.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star and 1. We take the next question from the line of Omkar Rane from Emkay Global Financial Services. Please go ahead.
Yeah. Good evening. This is Harsh here. So my first question, realization Last quarter, you said that the realization fell 10% sequentially, but more due to the adverse product mix and the ramp up of the Surat plant. So that this quarter, hello. This quarter, yes. So this quarter, sir, there was in Q4 there was a good kind of ramp up in or healthy pricing in the non-trade particularly, and we maintained kind of 42% share in the non-trade segment. So sir, why was our realization just 1% growth? Why not higher? This is my first question.
So I just tell you, just again our estimate. There are different level of price increases in different part of India, right? And perhaps our geography, the price increase was little lower than other zones, and particularly I'm talking of this. East also, we have a limited presence in Chhattisgarh, which is perhaps the least price zone in entire East, right? And in western part of India, Gujarat, I think initially there were no price increases, but I think I see a little bit of improvement in demand and prices are also going up now. So I think our footprint wherever we operate, like north, west, and a very small part of west, the meaningful price increase was not there, and that is why our price or NSR increase is about around 1%. So this is just based on the geo footprint which we have, which is little different than those players who are there in different
Yeah, got it. So my second question then is on the AMDCL cancellation of our AMDCL contract. We have reported 130 crores in other non-current assets. Just wanted to know, sir, what is the surety or the certainty of receipt of this or recovery of this cash in July, basically, whenever there is a hearing in the High Court. How sure are we?
We will not get. We are not saying that it will come in July. We are saying that the next thing is in July.
Okay.
It means own time. The matter is 2 days. I don't know when it will come, but we are sure it will. That's why we are showing it as recovery.
The last question, sir. What will be the clinker production in FY26 and the CC ratio?
Sorry?
clinker production, right?
Clinker production, yes.
92.26 lakhs tons.
Sorry, sir, you are not audible. Can you repeat?
92.26 lakhs tons.
Okay. Thank you, sir. Thank you. These were my questions.
Yeah.
Thank you. Please press star and 1 to ask a question. We take the next question from the line of Shashank Goyal from Biomara. Please go ahead.
Thank you so much, sir. I've got two questions. My first question is, after the big expansion, what is the next project we are looking to take up?
Come again, I think. Once again, come again. After Durg expansion.
Yeah. So after the Durg
you are going to take northeast.
Sorry, sir, your voice is lagging, sir.
So we are going to take Assam project after east expansion.
Oh, Assam. And so my second question is, are we on track to achieve the 30 MT guidance by 2030? And will we be adding 9 MT of capacity over FY27-30 after this project?
So we are reasonably confident that we will achieve 30 million ton by 2030. And our ongoing projects in East, they are well on track, right? So we are confident that we are going to achieve that.
Like both cements, the 30 MT and the 9 MT addition?
No, your voice is not clear.
Hello. Yeah, actually I was asking that will we be adding 9 MT of capacity over FY27-30 after the big project?
Not sorry, your voice is not so clear.
Hello, am I audible?
Shashank, if you could please use your handset and ask a question.
One minute, sir. Hello.
Yeah, go ahead. I think you're using
So like, will we be adding 9 MT of capacity over FY27 30 after the big project?
Yeah, after two projects only, yeah.
Yeah, okay. Thank you. That's all. Thank you so much.
Thank you.
Thank you. Please press star and one to ask a question. We take the next question from the line of Dhruv Sitlani from Everflow Partners. Please go ahead.
Thank you for the opportunity and congratulations on the good set of numbers. So I have a couple of questions. So my first question is that in the Q4, as one of the participants mentioned, that company de-recognized some crores of investment in Assam following the cancellation of the mining development agreement. Given that the limestone mine was the foundation of the Assam Green Steel plant, and can the management clarify on this? And also, is the Assam integrated plant still viable? Are you actively pursuing an alternative limestone source, or has a plan been revised to a grinding unit and that would source clinker externally? And what does this mean for the FY29-2030 timeline and the earlier indicated 2 to 2.5 MTPA capacity target?
You see this, earlier the AMDC had granted that MDO contract to the consortium, which was cancelled subsequently. But out of the 3 mines, we were able to get 2 mines under the auction route in JK Lakshmi. So based on these 2 mines, which have reserves of about 250 million tons, we are pursuing our northeast foray. So which will come after the
Okay, that is really helpful. My second question is that our ramp up on utilization from our new capacities in Dutch has been quite slow. What have been the factors for it, and by when do we expect utilization to reach regional averages?
Surat ramp up is well on track. In fact, we commissioned on around end of September, 22nd September 2025, and we are utilizing capacity more than 60% already. So we are well ahead of ramp up plan of about 18 to 24 months. So probably I think we'll reach even higher capacity this year, maybe 70% plus.
Okay, sir. Thank you. That was all from my side.
Thank you.
Thank you. Please press star and one to ask a question. We take the next question from the line of Prateek Kumar from Jefferies. Please go ahead.
Yeah, good evening, sir. My question is on your capex. So last 2 years, so capex have been 650 to 700 crores, with the large project commissioning with 4,000 crore kind of capex in FY20 for the ongoing east expansion. How do you look capex for FY27 and FY28?
This next 2 years will be quite high capex. We expect total capex in FY27 to be around 15 to 1700 crores and close to 2000 crores in the next year, when we would be also taking up we already started, but it will ramp up the land acquisition and the project in Kutch and Nagaur.
And timelines of east expansion, can you revisit that again?
We are expecting the Durg first to come by FY28, towards the end of that year, FY28, and 1 year later the northeast project should also be there, and followed by the greenfield thereafter.
Sorry, Durg clinker by FY28 and the supporting 3 grinding units by what time?
This is the Durg including the grinding units.
Okay, so Durg plus grinding units by FY28 end, and FY29 we commission northeast clinker.
Yeah, clinker and the grinding together.
Which is 1 million ton each, right?
Yeah, we have not firmed up the size, but we'll do that maybe around slightly higher than 1.5. And thereafter the Nagaur, Kutch and Nagaur in that order. Kutch first. Kutch should come earlier than Nagaur, because Nagaur there are issues in the land acquisition. That is taking time. So Kutch will get the priority. That will come ahead of Nagaur.
And in Nagaur, in fact, additional issue is of Aravalli now. So until unless that Supreme Court decision comes, I think that is why there is some delay on Nagaur part of it. But Kutch is going to be even before.
Kutch Nagaur is a FY30 onwards capacities, right? Like 30 to 35.
No, by FY30.
Kutch is for sure FY30.
FY30.
Sure. Another question on, like, so you exited this year, so last year, 2 years, we exited EBITDA per ton at like close to 1,000 rupees. This year we have exited at like 730 odd in terms of quarterly EBITDA per ton. With additional cost pressures which are very severe and price increases have not happened. So how are you looking at the profitability for the full year versus like erstwhile targets of 1,000 rupees per ton, which we were like to discuss earlier?
1,000 rupees per ton is of course the anchor, but if you really look at, cement EBITDA for even other, leaders also, that has also gone down, right? So definitely I think our ambition is to reach 2,000 EBITDA, but definitely we have been bridging our gap up with leaders in the last couple of years, and that, journey is continuing. And for that we are taking lot of measures which are internally controlled. So I think I have said all those levers even before. Major levers are of course I think on top line part of it. I think last year if you see our volume growth and even premium product, that has been at a good level. Despite volume growth, I think we are at our volume growth in premium product is also good. We are working on logistics. We are extremely focused on now renewable energy. We have closed at 46% of renewable energy. We do have plan to go even beyond. So that is another lever. Then digital is also being deployed in our manufacturing units, particularly in pyro process and grinding units. There we are deploying digital, AI ML capabilities, enabling them operations to have AI ML deployment, which is going to help us to improve efficiency and reduce costs. So all those actions are already there, and we are relentlessly working on that. So that remains. That at all we have not deterred from that. And whatever bridging of the gap which we have been able to do in the last couple of years, majorly goes to all those internal actions and efficiency levers we have worked upon. So that is going to continue in coming months and coming years also. But you definitely are going to see that our gap is going to further reduce with leaders in this FY27. And I'm sure that it is going to reduce at least by another 50 rupees to 75 rupees for sure.
But some of your industry peers have like reported like 1150, 1250, 1,000 rupees. Like which peers are we comparing to? Like because our gap seems very high this quarter versus like
I think
last year fourth quarter.
We are looking at grey cement data because some other cement manufacturers, they do have portfolio of other businesses also within that, right? But if we compare ourselves with grey EBITDA, then we are very much there, right? And I'm sure that all of you must be doing that calculation as well. Okay, and I'm in touch with some of you, and we do get that analysis done externally also. And if you look at that figure, then we are very much there that within our radar, and that gives us confidence that we are in the right direction, and that gap is going to get reduced even further. So just compare grey cement versus grey cement, because we do not have other than grey cement as of now. And
these are my questions.
Another thing, I think incentive also we only kind of factor when we realize that we do not take incentive on accrual basis. So that is also one of the differentiators. Okay.
Thank you. Please press star and 1 to ask a question. We take the next question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hi, sir. Good evening to the team. Sir, my first question, the housekeeping one, could you share the non-cement revenue and the RMC revenue for this quarter?
Yes, sir, very much. So, non-cement revenue was
Is 169.
169 crore.
Okay, and RMC?
Sorry?
RMC revenues?
82 crores.
82 crore.
82 crores, okay. Okay. Now coming to the capex plan which you outlined, 15 to 1700 crore this year and 2000 crore out for next year. If I do the calculation basis on the cost pressure and all the industry is reeling through, I see your net debt increasing by at least 1500 crore over next 2 years. So from over next 2 years, so that would shoot up your net debt level significantly. So how do you plan to manage that? And second question, you have you're among the lowest cost, quartile operating cost level. I believe if I do a line by line matching your numbers with Ultratech, you're better off in terms of your fuel cost. You have a higher share of green power. Your logistics costs are only distance are similar. Your overall cost is comparable to Ultratech's operating cost. But the margin is different, and obviously the difference is on the realization. Even trade mix, both the companies you are slightly off, versus their numbers in terms of trade. So what we understand is there is a sharp gap of 400 to 500 rupees, and that is what is, where I'm coming from, that you may have limited headroom, available on your costing front to squeeze your cost further. So what efforts are we doing to, increase our price premium or price positioning whereby the margins can sustainably move north of 700, 800 rupees? Hello? We can't hear anything, sir. Hello?
Am I audible? I think there is some disturbance.
Yeah. Now you're audible, sir. Please tell me.
Rajesh, as I mentioned before, I think this is one of the major focus area for us. How we are going to place our product at pricing level to our competitors in the market. This has been the areas, and we have worked that last maybe a year or so. We are further going to work on improving our price, and for that we do have that, placing, different band also in the market. For instance, we have rejuvenated our legacy brand, launched Green Plus. That was the whole idea, to improve our thing. Lakshmi already commanding a good, position in the market. We have to improve upon that. And over and above, now we do have, ambition of, we have already launched LC3, what we call in lime calcine clay. How we are going to ramp that up, that is also a plan for us, which is not only a green cement, this is as good as ordinary Portland, quite durable. So we are working on that as well, as to how we are going to get better volume from LC3 at the right price. So the strategy there, Rajesh, is right product, right price, and right market. I do feel that we have headroom there to further improve.
And on the net debt, sir, given the last capex we are planning for next 2 years?
Yeah, this will peak out. You're right that there will be an increase of almost 10 crores. But once the EBITDA from, because that is before getting the additional EBITDA from the Durg expansion. Moment that goes in, that will back to the normative law.
Okay, and sir, just on when you mentioned the clinker volume, if I we see the clinker utilization in FY26 is close to 93%. So for next 2 years, given that your Durg expansion will be back-ended in FY28 end, so for next 2 years, are we looking at sub 3-4% volume CAGR? CAGR I'm talking. So if you deliver 5-6% volume growth this year, chances of a flattish volume offtake we expect in FY28?
So we are going to grow higher than the industry in FY27 as well. And there are reasons for that. One, as I said, that we have reached about 60% plus capacity utilization in Surat, which we are going to ramp up. Right. One. Second, Udaipur, that capacity utilization we need to, take it up. Right. Second and third, we have that headroom in Cuttack as well. So these are the areas or the plants where we do have that headroom to grow this year at least higher than industry. Right.
So are you looking to purchase clinker externally, sir? Because at 93% utilization, are we, and if suppose we expect industry to grow at 7-8%, would we have enough clinker to support that growth?
I think we do have clinker with us at least 2 million tons, because last year.
Ladies and gentlemen, we have lost the line of the management. Please stay connected while I reconnect the management. Thank you. Ladies and gentlemen, we have the management line reconnected. Rajesh, if you could please repeat your question for the management. Thank you.
Yeah, so same question, sir. In terms of clinker availability, given that we are already operating at 93% utilization, and given if the industry grows at say 7% odd, and if we are targeting say 10% growth, how would that be achieved?
Yeah, so with even if we take, let's say, current product mix which we have, Rajesh, will go beyond 14 million ton, around 14.2 million ton, right, with the same level of capacity utilization of clinker. If I improve blended cement ratio, which was 62% last year, if I take to 65% and 94% of clinker utilization to about around, let's say, 97, 98, and the clinker which we have sold last year close to about 7 lakh ton, 7.5 lakh ton, then we do have that enough capacity to grow at that rate. So 3-4 things. One, improvement in blended ratio. Second,
your voice is breaking up, sir, again.
Sorry, I think there is some. Am I audible? No.
Yeah, you're audible, but in between it starts breaking up.
Yeah, sorry for that. So these are the three things. Blended ratio, further improving clinker utilization, 94 to let's say 97, 98%. And the clinker which we have sold last year, about 7.5 lakh ton, that we don't. Then we are there. We have calculated and we are there to grow at that rate. Yeah.
And lastly, if you could share just the Q4 clinker volumes.
Yeah, just a sec. Clinker production was 24.72 lakhs ton.
No, clinker sale in this quarter.
Clinker sale was 2.2 lakhs ton.
2.2 lakh tons. Okay. That's all from my end, sir. I'll come back and you. Thank you. All the best.
Yes, any question you can come back even after. Thank you so much.
Thank you. Please press star and 1 to ask a question. We take the next question from the line of Pradeep Kumar from Mittal Consultant. Please go ahead.
Thank you very much. My question is on the NISAM acquisition update after acquiring about 80% of the share of market. What is the latest status of the liability settlement? Has the liabilities been settled and the promoters got paid?
Can you repeat your question? I'm not clear, please. Your voice is very feeble.
My question is on the latest update on a NISAM acquisition in Northeast.
Yeah.
Where the transaction was supposed to be closed by the end of March, where 80% of the shares were acquired off market. So,
Right.
what is the latest on the settlement of a NISAM liability and the payment to the promoter?
You see, this transaction was consummated at a total consideration, as we mentioned, of about 19 crores and takeover of certain past liabilities. Now, those past liabilities have been settled in the month of March at a figure of around 12.5 crores. That is first part. Second, regarding out of 19 crores, which was the consideration broken up into 2-3 parts, we have paid about 1.5 crores towards the acquisition of shares. The other part, which is the non-compete fees of about 10 crores, gets paid after the entire transaction gets consummated. And additional about 7.5 crores is required to be inducted as capital into the company, out of which we have done about 3.5 crores. So we are hopeful that this transaction will in entirety gets completed in this quarter only. But most important was the settlement of the liabilities which were taken over. That has been settled at 12.5 in the month of March.
Thank you very much. That's it.
Thank you.
Thank you. This is the final reminder for the question and answer session, and no further reminders will be announced. Participants, to ask a question, please press star and 1. We take the next question from the line of Nilesh Sharma from Anandnath Skycon Private Limited. Please go ahead.
Thank you, sir. Thank you so much. I just wanted to understand what is the current operational capacity as of now, and for this financial year, how much capacity we can expect that will be operationalized?
We have current capacity of about 18 million, right? And last year capacity utilization was 73%. Okay. And as I said before, in the month of September, we added 1.35 million ton. So that is why the full year capacity last year was only 17.7 million ton. So this is what the capacity we have.
So any capacity that we are going to add in this financial year as well?
This financial year, no capacity addition, and that is what earlier speaker was our growth. So I explained him. We do have that improvement plans and which we have in our hands. So this year we do not have any capacity yet.
Okay. And sir, how much EBITDA per ton we are expecting in this year, considering all the effect of the war prices and all?
I think quite uncertain. I think maybe next quarter I'll update you. Just give me another quarter, because I think that depends on a lot of external environment which is beyond our control. But definitely I think we'll do better than industry in terms of all parameters. That we are confident about.
Okay. And although you have given the answer that you are still targeting 30 million for 2030, is it right, or you are planning to increase this target or reduce it?
We are on course.
Perfectly. So thank you, sir. We will meet in next Concall for any other update.
Thank you.
Thank you. We take the next question from the line of Akshay Shetty from Miraya Asset Sharekhan. Please go ahead.
Good evening, sir. Thank you for taking my question. I wanted to know, given the elevated fuel cost and rupee depreciation, How do you see input cost trending over the coming quarters, and what could be the impact on margins? Also, would the recent price hikes be sufficient to offset these cost pressures? And also, additionally, I wanted, what demand trends have you observed in April and May across your key markets?
Yeah. So, I'll just answer one by one because you combined two, three questions together. So first on cost part of it, just to let you know that we were dependent on imported coal and petcoke from outside in north part of India. East, I think we do have fuel which is indigenous. So east, we do not have much of an impact, excepting maybe your explosive cost, bag cost that has gone up. But north part also we have done quite a bit to kind of contain the cost increase by changing the fuel mix. So we are kind of changing the proportion of petcoke versus coal in our northern plant also. So that way we are going to mitigate the cost increase to an extent which is coming on account of imported coal and petcoke. So that is one thing which we are doing. So even if that impact is going to be higher, we'll try to mitigate it to an extent by changing the fuel mix in our northern plant, right? If you look at last quarter, we had this fuel cost of about 1.58, 1.54, yeah, 1.54, right? So I think this will definitely go up, despite our effort to kind of change the fuel mix. So this is one of the mitigating measures we are taking just to preserve our margin to an extent. And second also, you asked about our core market. So I think overall India, I see a growth of about, estimated growth of 6%. Our markets are also going to grow in the similar line. Maybe I think geographical, here and there, some, percentage here and there would be there, but as I said before, we'll grow at a higher rate than industry, which is estimated to be growing at 6%. Right. So just to summarize your, answers, one action is to mitigate the cost increase to an extent by changing the fuel mix. Second, of course, I think working on some of the levers to further mitigate that, impact. And typically on top line by which I mentioned, blended cement, maybe, trade percentage, working, right product, right market, right price. So those things we are going to take. And on growth part of it, definitely I think we'll grow similar line and even a shade better than industry.
Yeah, thank you. That was very useful.
Thank you so much. Thank you.
Thank you. We take the next question from the line of Parth Bhavsar from Investec. Please go ahead. Parth, please unmute your line and proceed with your question.
Can you hear me?
Parth, please use your handset to ask a question.
Hello, can you hear me?
Yes,
yeah,
please.
Yeah.
Hello. Sir, thanks for the opportunity. I have a couple of questions on costs. So, sir, you guided for a 300 rupees per ton sort of a per ton number increase on energy cost and an 80 rupees per ton due to packaging. So, what sort of number will we see in Q1? Will the hit be entirely in Q1? And how much can we mitigate through our cost measures?
So what I see, maybe the 300 impact would come somewhere around quarter 2. But this quarter, definitely I see somewhere around maybe 100 to 120 or 130 rupees a ton.
Versus the 400 rupees per ton that we are guiding, including packaging and energy, right?
Yeah.
Okay. And sir, like how much of this, again, 120 rupees per ton sort of a number, we are seeing a dent in Q1. So to mitigate that, what sort of price increases have the market, has the market absorbed till now?
As I said before, non-trade prices have gone up in various markets. Trade prices are also inching up, but not to that extent. Once now demand I see is getting better. As I said that May beginning was a bit sluggish. I see a little better demand in latter part of May, and probably now since demand is improving, prices also will inch up even in trade segment also. So trade non-trade prices also will go up, and I am confident that we'll be able to kind of since demand will support, we'll be able to recover or pass on majority of the cost increase which we are going to have. This is what I kind of foresee as of today, but that depends on a lot of external factors, right? How demand behaves and how competitive intensity is. So that depends on a lot of things. But this is what my fair estimation is.
Fair enough. And sir, what would be our blended mix in Q4 and for FY26?
Yeah. So blended was 62%.
Okay, and for 26?
26. So whole year is 63. 62.
Perfect.
62.
62.
Yeah.
Okay. Perfect, sir. Those are my questions. Thank you so much.
Thank you so much.
Thank you. We take the next question from the line of Shravan Shah from Dolat Capital. Please go ahead.
Hi, sir. I have a couple of questions. Just wanted a curiosity or maybe a request. Sir, do you have any kind of a problem with me, because I feel, or maybe the organizer not allowing or maybe allowing at the end of the call to ask the questions. And if you wish that I do not ask the questions, I don't mind. So just wanted.
Oh no, sir. Sorry, sir. If you are getting that impression, please, I think, ask as many questions you want, and I will invite you to come to my office. Or else I will come to you and meet you, sir. You are most welcome.
I would love to meet you, sir.
Yeah. Please do that. Let's meet as early as possible. I'm very, because I get a lot of insights from you. That really helps me.
Yeah. Thank you, sir. A couple of questions. Most of things has been covered. Just continuing the previous past question. So broadly, to understand in Q1, if we see 120, 130 costs and maybe a 50, 70, 80 rupees, so maybe 30, 50 rupees kind of and plus some operating deleverage, so maybe a 80 rupees kind of a EBITDA per ton reduction broadly at current level. That's the way one can look at.
So, Shravanji, as I said, I think that depends on a lot of things. Maybe I think if demand supports, then I think we'll be able to recover full cost increase also. We're not too sure about it. Very difficult to really kind of give an estimation. But broadly, we think that yes, we have not been able to kind of increase our prices to the extent cost has gone up. But if demand supports, then maybe I think we'll be able to recover also. So we are not sure as of today, but what we are focused as of now at JK Lakshmi Cement is to work on all those things which we have control over, and which I said a couple of things which we are working on, like to mitigate the cost, Shravan. We are working on fuel mix in our north plant, right? We are working on further improving our renewable energy and improving TSR and all those low cost fuel. So those actions we have already started taking. So our focus is to really work on all those things which we can control, and let's see if things go all right, then maybe I think will be even better.
Got it. Sir, couple of data points. Non-cement margin would be for fourth quarter would be how much? 4%?
4%. You are right. You are absolutely right.
And the AAC block revenue would be 58, 60 odd crore for this quarter?
59. Oh, Shravan, you are absolutely on the dot. 59 crore.
Thank you. Sir, just wanted to know this Durg 3,000 crore capex that the total we have. Out of that, how much we have already have done by FY26 by March end? how much already spent?
We have done about close to about 500 crores.
Okay, 500 crore is done. And roughly, if you look at
including the railway siding.
Yeah. So roughly now, if we look at, obviously we will still be finalizing in terms of the capacity for the Assam. So roughly, if I have to look at 100 crore base, and for maybe by FY29, now we are saying FY30, obviously the Nagaur will depend. But broadly, if I leave apart the Nagaur, how much we need to spend by FY29? Broader number, just wanted to understand.
Yeah, as I mentioned in response to earlier question, FY27 we are seeing about 1,500 to 1,700 crores of capex, and then 2,000 crores at least in FY28, and maybe 13 to 15 in the FY29.
Okay, got it. And sir, just one thing, intangible assets, which was 329 odd crore in FY25 and September, and now it is just a 5 odd crore. So any accounting adjustment or?
Which asset you are talking of?
In balance sheet, intangible assets that we have. So that was in Concall balance sheet, it was 329 odd crore was there.
Yeah.
Which is now is just a 5 odd crore. So just wanted to know.
Because you would have read in our notes, we have in the Concall results we have de-recognized the mining rights, because of the cancellation of the.
Okay, that's the one. Okay.
325 crores gets knocked off. That's how 329 goes down to 5 crores, right?
Okay.
That is appearing in the note.
Yeah, got it. And lastly, sir, two data points. The CC ratio for fourth quarter and the power cost would be the similar 5.37 per kilowatt for fourth quarter.
Yeah, the CC ratio, Shravan, is 1.44. And what is the next question?
Power cost for fourth quarter, 5.37 was in third quarter.
5.34. 5.79.
5.7. Okay, got it, sir. Thank you and all the best.
Thank you, Shravan. Thank you so much.
Thank you. We take the last question from the line of Rajesh Ravi from HDFC Securities. Please go ahead.
Hello, am I audible?
Yes, Rajesh.
Yeah. I think you mentioned for the Durg project 3,000 crore till FY26 end we have incurred 500 crore. Is this understanding correct?
Yeah.
Okay, and sir, how do you, if I just look at the Durg project capex for next 2 years, how would that be phased out in terms of capex outgo?
Total, as I mentioned, including the land acquisition and also the Northeast project together, we have talked of 15 to 17 in response to your earlier question in 2000 in FY28.
No, I just wanted to understand, even if you want to delay the Northeast project and prioritize the Durg project, so in that way, in that case, how would the capex number would look like? Given the market is will
not delay.
Okay, will not be delaying. Okay.
Yeah.
And so this Sirohi TSR project, by when is that expected?
TSR, I think phase 1 is over. Phase 2 we have not yet taken up because the availability of alternate fuel is not that great around that plant.
Mm-hmm.
So right now I think we just have phase 1 we have completed. Phase 2 also we are contemplating, but we have not yet finalized.
Okay. And the railway siding Durg second phase, is that work going on that?
I think we are dependent on lot of other agencies. Like we have to put up one flyover, and that passes through one PWD road. So that we have to really get it done through them only. So there is delay from their end. And another one is strengthening this existing track, which again with this Steel Authority of India Limited. So once they are then I think that will get done. But nevertheless, I think our operation is going on full swing. There is no issue on that. So once they are kind of ready with all those things, then we kind of do that. So there is no delay from our end.
Understood. And so this non-cement revenues, there were earlier targets of the growing this at 30% CAGR, but last 2 years we are seeing around 10% revenue CAGR. So any thought on that? Why we are not aggressive on, in this segment, the non-cement revenues?
Non-cement revenue you're talking, Rajesh?
Yeah, non-cement revenue, sir.
I think we are going as per plan, and yes, I think ready-mix plant which we wanted to set up, I think we are little behind our projection. But in AC block area, AC area, I think we are kind of as per the plan we are going. In other products like plastering solution, tile adhesive, we are growing well, I think, and the high margin, and though I think revenue-wise will not find that much, but I think that gives a decent margin. So there I think we are as per plan only. Ready-mix has not gone as per the plan, and the reason was also because we want to grow in the area where we have our cement footprint. And the fact, ready-mix, you have got margins also on lower side. We focus on other than RMC so that we get better margin, though I think revenue-wise we are little lower. So that was a very conscious and deliberate call.
Understood. And so lastly, when you talked about the quarterly Q1 outlook, and you said that April was good, May started off on a weak note. So overall for the quarter, what sort of growth you're looking at, sub 5%, given that the market has been subdued, and the cost pressure you're looking at close to 150 rupees in Q1, Q1Q, and around 50 to 70 rupees cost pass-through has happened. Is this understanding correct?
So, growth-wise, Rajesh, I think, though I think May initial was little sluggish, but overall I think April, June is going to be better and will grow in alignment with the projection. So I don't see it's going to be an issue in terms of growth, right?
Okay. And
yeah.
Yeah, so cost and margin. Yeah, please go ahead.
Yeah. 120, 130 rupees ton. So that impact will come in this quarter. But next quarter, I think impact is going to be even bigger, right? And the whole idea is if demand picks up, then perhaps I think we'll try to recover this from the market. Okay, but and I suppose that now demand is little looking up. So going forward, but I think you do have other challenges also because of petrol and diesel hike. That is another element which is coming now into force, and that is going to impact our logistics cost. If you add that, because in the last maybe a week or so, you have already seen that about 4 rupees per liter increase, right? And that into about, let's say, 15 to 16 rupees a ton, if you really.
Yes.
Yeah. So I think let's wait for some time because cost and the other external scenario is so volatile. It's very difficult to really kind of calculate as to what is going to happen and how much you will be able to pass on.
No, I just want to checking if this 2 months, April, May, have you been able to effectively pass on the cost increases, or that have been suboptimal?
April, I think, thanks to our inventory also, at least we have been able to do that in April.
Understood. So that's all from my end. All the best, sir. Thank you.
Rajesh, thank you so much.
Thank you. With that, we conclude the question and answer session. I now hand the conference over to Vaibhav Agarwal from PhillipCapital India Private Limited for closing comments.
Yeah. So just a couple of quick questions. One thing you said on the call, 120 rupees of unpassed of inflation expected in Q1. So you are unadjusted for the price increase, if any, right? I just want to reconfirm that. You said 120 rupees. You said 120 rupees. You said 120 rupees would be the expected cost inflation in Q1. That's what you indicated in terms of the cost inflation for the current quarter. So you are not adjusting this for any price increase which potentially could be passed on or which has already been passed on, which is rolled back. So it is purely the cost inflation, right? 120 is purely the cost inflation number you're saying.
It's cost inflation, purely cost inflation I see, right?
Okay. And sir, yeah.
Yeah, go ahead.
No, please continue, sir. Yeah, please continue.
No, I am through, I think.
Okay. And second question, sir, was that we recently got to know that you have now partnered with some manufacturers for iron rods, etc. So JK Lakshmi steel rods, etc. Also been rods have also been marketed sold in the market. So what's the management broad thought process? Are you going to get into multiple building material products, like starting with maybe furthermore anything more in the ambit on, and what is the management thought process of getting into newer product lines, and what is the kind of income which you are expecting from all these businesses?
So, Vaibhav, I think first I need to correct you. We are not at all going into iron ore area, right?
No, the steel rods I'm saying, which were.
But I think we are piloting it because if you really look at distribution network of all those products like TMT and all,
right,
that has quite a synergy with cement channel network.
Right.
The idea was, can we leverage our brand strength? We are not at all going into manufacturing. We are not at all going into distribution. We just wanted to pilot it. If at all we can leverage that brand strength which we have in different markets. Right. That is at a very, I would say, nascent stage, a very initial stage. So I'll not be able to comment on quantifying.
The broader management thought process is also to get into more products in the future, or this is only after the testing of this product only you will take a final call as to what needs to be done.
Definitely, our effort or our thought, or the strategy is to go to adjacent building material for sure, because that we want to give our customers portfolio of products. So we definitely want to go into adjacent building material, and you see that tile adhesives, plastering solution which we give, and then AC block, RMC. I think all these adjacent product only, which is being used in building materials. So definitely, I think our not only you do have n number of other products also, which we may explore in future. But yes, strategy wise we do have that thought.
Right. So that's what I wanted to know. I did not say manufacturing, sir. I just meant you have tied up with some manufacturers and you are just lending them their brand and charging some royalty in terms of brand fees, or that's what I was commenting. Okay, thank you, sir. That's all from my end, and thank you. On behalf of Phillip Capital India Private Limited, I thank the management of JK Lakshmi for the call, and also many thanks to the party for joining the call. Thank you very much, sir. Ryan, you may now conclude the call. Thank you.
Thank you so much.
Thank you. On behalf of Phillip Capital India Private Limited, that concludes this conference call. Thank you for joining us. You may now disconnect your line.